trillion question. So number one, for the US, we have 150 basis points of rate cuts next year, 1.5%, but starting in May, not March. So the market now is pricing in a higher probability of March. We think there still has to be inflation come down further, the Fed to see that, or weakness in unemployment for it to shift earlier. And for the ECB, we have fewer rate cuts, 75 basis points, but inflation is also coming closer to target, and growth is relatively, anemic. It's not really above expectations. Hence, we think those rate cuts can also come through later in the year for Europe. Yeah, good question. No landing, soft landing, or hard landing. We're in the moderate landing camp, so we don't think they're going to have 2 negative quarters of growth in the US, which would be technically a recession. And then we have a gradual recovery in the second half of the year. Full year GDP about 0.9%. So we're not in the soft landing camp, and we're not in the hard landing camp. We're in between. The reasons why: fiscal stimulus is still there. Secondly, unemployment, we don't have a huge spike. And thirdly, you have easing financial conditions in the second half of the year with the rate cuts. So we saw tremendous performance from the Magnificent Seven stocks, up over 100%. We're playing for a broadening of the market. So we're overweight healthcare, which was a laggard sector last year, and is starting to outperform this year. Financials, materials, and energy. So all these sectors underperform, of course, technology last year, and we do like selected technology sectors and shares related to AI and the broadening of that trend, but we are playing other sectors as well this year. Yeah, I mean, obviously the supply chain overall is much better. So goods inflation and shipping rates, until very recently, but we'll talk about Red Sea in a moment, have come down tremendously, and there aren't supply shortages. Also, the global economy is slowing, so it's a very different environment than when we opened up after the pandemic. Of course, now we have tension with what's happening in the Red Sea. So there is a little bit of a pickup in shipping rates, but from very low base, and a move to air freight for companies who cannot wait for the extra time. So the key there will be how long it lasts, which we don't have a crystal ball in terms of its length. But in and of itself, it's not enough to overwhelm or change the inflation outlook. It's more of a short-term setback.